Hello financial fans, welcome back to another stock analysis. Today we'll be covering Berkshire Hathaway stock ticker BRK.B. Berkshire Hathaway is a multinational conglomerate holding company headquartered in the United States. Berkshire Hathaway was founded in 1839 as the Valley Falls Company, which was a textile manufacturing company based in Valley Falls, Rhode Island. Warren Buffett, who is widely regarded as one of the most successful investors of all time, became the chairman and CEO of Berkshire Hathaway in 1965. Charlie Munger joined the company in 1978 as the vice chairman. Since then, they have played a significant role in shaping the company's strategy and portfolio of investments. Berkshire Hathaway operates through a diverse range of subsidiaries and investments, which are spread across different industries such as insurance, utilities, energy, manufacturing, retail, and finance. The company owns well-known brands such as Geico, Duracell, Dairy Queen, Fruit of the Loom, and many others. The primary source of Berkshire Hathaway's revenue is its insurance business. The company operates through its subsidiary companies such as Geico, National Indemnity, and General Ray, among others. In addition, the company also generates revenue through its manufacturing and retail businesses. One of the key strategies of Berkshire Hathaway is to acquire companies that have strong fundamentals and can generate stable cash flow over the long term. The company typically acquires companies that are undervalued or have strong growth potential. Once acquired, Berkshire Hathaway typically allows the acquired company to continue operating as an independent entity with the aim of preserving its culture and management team. Berkshire Hathaway is also known for its value investing philosophy. The company invests heavily in publicly traded companies that it believes are undervalued or have strong growth potential. Some of the notable companies that Berkshire Hathaway has invested in include Coca-Cola, Apple, American Express, and many others. In summary, Berkshire Hathaway is a multinational conglomerate holding company that operates through a diverse range of subsidiaries and investments. The company's primary source of revenue is its insurance business, and it also generates revenue through its manufacturing and retail businesses. They are currently sitting at a $667.9 billion market cap, and in 2021 they generated a revenue of $89.8 billion, and they're the sixth biggest company on earth at the moment. 27% of their revenue comes from their insurance business, 25% from manufacturing, 18% from distribution, 13% from services, 9% from energy, and 8% from rail transportation. When determining the final valuation of the company, we'll be using a margin of safety. This margin of safety will be based on the financial ratios, the financial health, and the growth of the company. I will be using a standard margin of safety of 20% that can never be below 0%. The margin of safety can either increase or decrease by the ratios that we're going to look at in just a moment. And the severity that the margin of safety will increase or decrease by will be determined by using a scale. When we're using 4 colors in a scale, bright red will mean a 5% increase, orange will mean no change, light green will mean a 5% deduction, and bright green will mean a 10% deduction from a margin of safety. When we're using 3 colors, bright red will mean a 5% increase, orange will mean no change, and bright green will mean a 5% deduction from a margin of safety. The first two metrics that we'll be looking at are the EBIT growth and the margin growth. The EBIT has grown, going from $24.3 billion in 2012 to $114.8 billion in 2021. The average EBIT growth during this period was 22.1%, meaning a 10% deduction in a margin of safety. The margin has also gone up, going from 15.12% in 2012 to 41.6% in 2021, which is a big increase. The average margin growth was 91.1%, meaning a 5% deduction in a margin of safety. The final two metrics that we're going to use are the debt to EBITDA and return on invested capital. To get a debt to EBITDA ratio, we have to take the debt of the company, subtract the cash from it, and divide it by the EBITDA. Out of this, we get the amount of years of EBITDA it takes for the company to pay off all of their debts. For Berkshire Hathaway, as you can see top left on the graph, they have more cash currently than debt, meaning they can pay off all of their debt just using their cash. This indicates a 0% debt to EBITDA ratio because Berkshire Hathaway has no net debt, which is a 5% deduction from a margin of safety. The return on invested capital for Berkshire Hathaway is 0.01%, but we're not going to use this metric since it's irrelevant for this industry. Looking very good so far for Berkshire Hathaway. Let's go look at the valuation models next to determine the intrinsic value of the company. The first valuation model that we'll be using is the discounted cash flow model. I've imported the free cash flow of Berkshire Hathaway going from 2012 to 2021. The average growth in free cash flow annually during this period was 13.8%, and I'm projecting an expected growth rate of 6% over the next 10 years annually in the free cash flow. With this percentage, we can determine the future free cash flow of Berkshire Hathaway and determine the terminal year of valuation using a perpetual growth rate of 3% and a discount rate of 9%. This leaves us with a sum of free cash flow of $525.5 billion, and to get an equity value, we have to add the cash and equivalents and subtract the debt, leaving us with an equity value of $587.5 billion. All that's left to do then is to divide it by the amount of shares outstanding, leaving us with a discounted cash flow price per share of $452, which is a 49.45% upside from the current price. Second model that we'll be using is Graham's revised valuation formula. In this model, we'll be looking at the earnings per share that Berkshire Hathaway is generating, the growth rate estimate projected by Wall Street, and the current yield of AAA corporate bonds. And we go by the theory that a company with no growth is always sitting at a PE of 7. And taking into account all of these metrics, we get a fair value of $290.81, which is a 3.84% downside from the current price. The third model that we use is the multiple valuation. In this model, we look at similar companies to Berkshire Hathaway, look at their stock price and their earnings per share. In this case, I've chosen companies that represent a part of the business that Berkshire Hathaway has. And the average PE multiple of all of these companies is 14.34. And all we have to do to get a fair value is to multiply by the earnings per share that Berkshire Hathaway is generating, giving us a fair value of $202.19, which is a 33.15% downside from the current price. And the last model that we'll be using is the mean reversion theory. In this model, we go by the theory that a company will always trade above or below its mean. And the metric that we use to determine this is the PE ratio. The average PE ratio that we've imported from the past 5 years has been 22.54, and the current PE ratio is 21.44, meaning that it's currently slightly cheaper than on average. This gives us a fair value of $318.01, which is a 5.15% upside from the current price. If you want access to all of the valuation models that I use in my videos and more, you can head to the description and check out my Patreon. Anyways, getting that out of the way, let's go look at the final overview of our valuation model. Looking at our final overview, we've imported the discounted cash flow, Graham's valuation, the multiple valuation, and the mean reversion theory price per share, giving us an average of $315.75. Our margin of safety we've determined earlier, using a standard margin of safety of 20%, deducting it by 5% for the debt to EBITDA, 10% for the EBIT growth, and 5% for the margin growth, giving us no margin of safety at all. This gives us the same fair value as the average out of the models. And with the current price of $302.44, we got an upside of 4.4%, meaning that it's currently indicating a buy. If there's any other companies that you would like to see me cover on this channel, please let me know in the comments. And thanks for watching.